Welcome back. Well, the markets are more or less flattish, but let's focus on another company, Indigo Paints. It posted a rather good set of numbers in the second quarter. The revenue jumped up by close to around 24%. The gross margins as well remained flat at around 41%. Well, to discuss the past quarter's performance and what's the way ahead, we're joined by Mr. Hemant Jalan, the CMD at the company. Hi, Mr. Jalan. Morning. Thanks so much for joining in. Well, you've grown well. On the top line, did you gain any kind of market share this quarter? If yes, tell us how much.
See, I'm sure we have, at least for the companies for which the quarterly results have come out. If the top line growth as a percentage is higher than others, then definitely we would have gained some market share. So the product profile or the product mix across all companies is pretty much similar. So I think we are seeing a breakout in our growth rate versus the other paint companies. We had predicted that at the end of the last quarter, that we said that we are now focusing on marketing in the larger cities, and that will slowly start producing results. The first semblance of that result is visible in our top line growth this quarter. We are hopeful that the disparity between the growth of the industry on top line and our growth rate, that difference will widen as we go forward, and that is the ultimate objective of the company.
Okay, can you tell us a little bit about raw material costs? How much have the RM prices reduced by, and what kind of margin expansion can we see going forward?
So there are two or three things that happen as far as margin expansion is concerned. Q2 is always the worst quarter for any paint company in terms of margins because the product mix deteriorates. In Q2, which is completely a monsoon quarter, July, August, and September, exterior paints don't sell very much, which are the slightly more profitable kinds of paints. So if you will notice, for all companies, the gross margin is usually the worst in Q2. It rises in Q3, and it is normally the highest in Q4. So we do expect that our gross margins will go up as we move forward. As far as the earlier question about raw material prices are concerned, raw material prices for several ingredients in water-based paints are beginning to soften. They have softened during the course of this quarter. We see signs that they will continue to soften as we go ahead. But raw material prices for solvent-based products are not softening as yet because, crude oil prices remain high. But of course, for us, the higher input is the water-based raw materials. And there we are seeing some softening. So I don't think that there is a likelihood of any price decrease happening at this stage because prices have not come down to that level. But definitely there is more aggression on the ground as far as passing trade discounts and schemes to the primary channel is concerned. So that is happening for all companies and also with us. And I expect that aggressiveness in trade discounts to continue in Q3.
Mr. Jalan, in your presentation, you say that you plan to, and I quote the presentation, grow aggressively and expect sharper improvement in profitability. Could you quantify both those things?
See, I can't give you value guidance in terms of what the growth percentage would be. The objective is that the gap between the industry top line growth and our top line growth just now is visible at the level of 4 or 5 percentage points. That gap should widen as we go forward. That is our attempt. How the aggression will play out, as we have said in the last 2 quarters, that we are focusing on growing in the larger cities where we were underserved. Our primary strategy for the previous 20 years was to grow in the smaller towns. We are now aggressively attacking the larger cities in India, and we have identified 750 such cities to lead this expansion. It is beginning to show very good results, but it is not something that will play out in 1 quarter or 2. It's a more long-term strategy. Along with that, matching aggressiveness on the ground in terms of trade discounts, bolstering up your part of your sales team that engages with painters and painting contractors to generate secondary demand from your paint dealers. All of those things are items on which we continue to be aggressive and will continue to be more aggressive in the coming quarters.
All right, talking about aggression, sir, what about ad spends? Where will they stabilize as a percentage of sales?
So again, we have said in the past that our ad spends will go up in absolute terms by maybe 5 to 10% on an annual basis. But since the top line is expected to grow at a much faster pace, therefore ad spends as a percentage of top line will decline by maybe 1.25 to 1.5 percentage points year on year for the next 2-3 years. Beyond 2-3 years, what do we do with ad spends? Do we again start increasing it more aggressively or not? Is something a little far away to predict. But for the next 2 or 3 years, you can expect an ad spend to decline as a percentage, not in absolute terms, as a percentage of top line by about 1.5 percentage point every year.
All right, so what is the growth that you can guide for going forward? How much will the growth of Indigo Paints be versus, say, the industry?
In this quarter, you can see our EBITDA has expanded by 45%, 44, 45% this quarter. PBT has expanded by 53%. PAT, there is an expansion of 173%, but even if you discount that one-time reversal of a tax provision, PAT has also grown by 53%. So I think that is by far the highest as far as the industry is concerned. So we do hope to grow aggressively, not only on the top line, but even more aggressively on the bottom line as we go forward.
Mr. Jalan, it's a pleasure. Thank you very much for your time and good speaking with you. So stock's down about 4%. It's pulling back some of the gains that we saw on the name in a trade yesterday. The market is, more or less flat. It was up 50 points. We're down about 13 points now. So it's in the red. Market breadth is also evened out. It was overwhelmingly in the green, and now it's evened out. 1,210 stocks are higher, and you got about 800 stocks which are lower. So the gap is narrowed a little bit, not in a good way. Mahindra Life Spaces is the next company that we are speaking with. The business update looks weak sequentially owing to the high base, but it's a decent performance versus last year. Remember, the company did warn and was conservative in Q1, where it was a record showing that, the run rate perhaps is a little unsustainable. But bookings have actually halved. So let's understand what is the future looking like. Arvind Subramanian is Managing Director and CEO at Mahindra Life Spaces, and he's joining us right now on the program. Arvind, great to have you with us here. Thank you very much for your time. So just explain to us what happened in the second quarter. And as I said, bookings seem to have halved. What's the run rate for the current quarter, and the rest of the year now?
Morning, Prashant, Sonia, Nigel, wonderful speaking to you. So actually, second quarter, as we had teed up at the end of the first quarter, has played out better than expected, I would say. We've ended the second quarter at a strong run rate on both the residential as well as the industrial business, taking the first half of the year to just over 1,000 crores of residential sales and about 186 crores of industrial leasing. Both of these are very important thresholds. The 1,000 crores of residential sales is psychologically a great boost for the team. It sets us up very well for the second half of the year. One must bear in mind, as I had spoken about at the end of quarter one, that we had two very strong new launches in quarter one that created the high base that you mentioned, but also that quarter two is seasonally a weak quarter for real estate, particularly Mumbai real estate, because of the monsoon and the month of Pitru Paksh, which is an inauspicious period for many customers to buy new apartments. So despite that, doing 400 crores of residential sales in the second quarter, I think has delivered a very solid first half of the year for us and a platform for growth into the second half.
So when you talk about a platform for growth, what are the numbers that we're looking at? Arvind, good morning. You've done about 1,000 crores of bookings in the first half and volumes a little over 1.1 million square feet. Is that a run rate that you can repeat in the second half?
No, I don't think we will double for the full year. As I had said, first quarter, we had some very strong new launches. We do have a good pipeline of new launches for the second half of the year. We are bringing forward the second phase of Mahindra Eden in Bangalore. As you would recall, this is India's first net zero energy project, which we had launched in Bangalore in the first quarter. The response was fantastic. We sold 90% of the inventory in the first half of the year that was launched. And that has prompted us to bring forward the second phase, which was originally planned for sometime in the next financial year. We are launching it starting this weekend, actually. That will be followed up by a launch in Chennai, which is the Happiness at Mahindra World City, Chennai. We will also be launching our Happiness in Kalyan in MMR, which is, so Q3 looks like a busy quarter for us. And getting into Q4, we will be launching a new land parcel in Pimpri in Pune, which we had acquired in April this year. So lining that up for a launch in Q4.
So since you have big launches and you're not giving me any numbers for FY23, let me ask you about your guidance, right? I mean, you have a FY25 guidance of 2,500 crores of bookings. Do you reckon that given the new launches, the demand pickup, you can meet that guidance in FY24 itself?
I wish I could say that. Let's hold on to the guidance as FY25 for now. Let's see how this year plays out, and then we can recalibrate. Look, a lot of this, and I'm not being coy about this. It's a lot of our business is based on how we can ramp up the pace of land acquisitions, which is why I want to hold my horses a little bit.
Okay, all right. Staying conservative, I would say, Arvind, going at the run rate that you're currently progressing at. Let's ask you a couple of more factors. And the sales were around 399 crores, right, in the second quarter. How much of it came from new launches? If you could give us a sense on that front. And also, I understand that you take quarterly price hikes, right? For quarter 3, is there going to be a price hike? If yes, could you quantify it?
Yes. So in of the 399 crores, roughly 135 crores was a new launch in Pune called Mahindra Nostalgia. So I'd say about 35% of the quarterly sales has been new launches. The rest has been very solid sustenance sales across the portfolio. And the entire portfolio has contributed from Gurgaon, Luminaire in Gurgaon, all the way to our projects in Chennai. So that's been heartening. We've also been able to take very significant price hikes in Q2 itself, despite it being, as I said, a seasonally weak quarter. In many of our projects that have been performing well, we've taken price hikes as high as 8 to 10% within the quarter itself. We will continue to maintain the discipline of roughly 1.5% per quarter price rise. And that's kind of a secular price rise we do every quarter. Depending on which projects perform better, we try and increase the price realization on those.
Arvind, any update on the Mumbai redevelopment work that you alluded to last couple of quarters?
Those are always so near yet so far. The redevelopment decision process tends to be a winding road. Understandably so, there are lots of members who need to weigh in on the decision. So we are in very advanced conversations with 3 societies and hoping in the second half of this year, at least 1 or 2 of those will convert into definitive documents.
Okay. All the best, Arvind. Thanks for always joining us, speaking to CNBC-TV18 and giving us an update on the business. That's Mahindra Lifespaces with the way forward for the business. They stick to their FY25 guidance of 2,500 crores of revenues, although Q2 bookings have been much better than what they were expecting. Let's slip into a quick break on that note. Up next, Mitesh Thakkar and Shrikant Chauhan will be joining in with some technical trades, and we'll also get you the buzzing stocks of the day. Stay tuned.
Okay, welcome back. We've got the market, which is down 18 or 20 points off the highs of the day by about, 60, 70 points. The high point of the day, which of course came right after market opening. Mitesh Thakkar is with us to help us understand what to do in terms of trades here, Nifty and both individual stocks. Mitesh, your thoughts now.
Prashant, I think the index is still, continuing that consolidation kind of phase. So I would maintain that closer to 17,950 attempt along with a 50-60 point kind of a stop, closer to 18,200 try to take profits. I think that strategy remains. But that about, I think, Bajaj Finserv is something which is breaking out very nicely today. That's a buy with a stop below 1750 for targets of 1830 on the upside. And apart from that, I think there's a strong breakout also seen on the charts of Dredging Corporation. It's a cash stock not regularly tracked. But this time, I think the breakout is very, very strong. And this could see the stock head towards levels of 435 to begin with. So that's a buy with a stop below 384.
All right. Thanks a lot for that. Let's shift gears to the commodity markets. Manisha Gupta is joining in. Manisha, good morning again. What's the one commodity you're looking at today?
I'm looking at rubber prices. There are a lot of factors which are weighing onto the commodity right now. The sell-off in crude oil prices is one of the reasons. In this week itself, you have seen the rubber prices decline by 3%. We saw 8% of a decline in the month of October, and we're trading at a 2-year lows in the international markets there, down by nearly 20% in this year until now. When you look at the international prices, they're trading even lower, 20 to 30% from what Indian markets are doing right now. So yes, it is weak global cues that continue to weigh onto this industrial agriculture commodity there. The US, Europe, and China demand continues to be on the weaker side. There are recession fears, weak demand from the automakers, and that's weighing onto the prices there. And the 75 basis point rate hike that you've seen come in from US, ECB, and Bank of England continues to weigh on the fact that the demand could dampen going forward from here as well. And then you have China, which is looking at even weaker demand. That is a statement that came in from Bank of England saying that Britain has entered into recession and they do not see recovery in the next couple of years as well. China is another important factor which consumes 42% of the global natural rubber, and we are looking at weaker cues coming in from China. The COVID restrictions have just about continued, and the start-stop economy that China has become now is weighing on most of those businesses there. The COVID cases in China are the highest since the month of August. There is a lockdown in 28 cities in China, and China also has dismissed that speculation on scaling back of COVID restrictions even from March 2023. They've said that they will go as the day comes. So that is what is weighing on to many of those commodity prices there. And then you have weak demand coming in from automakers. The SMEs and MSMEs in Indian market also have weak demand coming in. And then you are looking at oversupplying the global and the Indian markets as well. Pair that with weak demand, and that's weighing on. In the Indian markets as well, this is peak tapping season. You are looking at arrivals coming into the market. But even with that, there is an expected 5 lakh tons of a shortfall in the Indian markets, and that would come in from the international markets, which are even cheaper. Markets do believe that the stocking should begin now because the prices are low and quality when the tapping is happening is actually better. And this is the time that many of the stockists and bulk consumers start to buy in case of rubber there. When you look at the prices, then the industry estimates that even as we've seen 20% of decline in rubber prices until now, another 3 to 5% of a fall before this year ends is what they're estimating.
Okay, thanks a lot for that. By the way, the market may be very quiet, but there are plenty of stocks that are moving around right now. Ajanta Pharma is one of them, and Ekta is here to tell us why she's tracking that. Ekta, over to you.
Well, definitely a weak set of numbers when it comes to margins for Ajanta Pharma. So it's coming at a multi-quarter low of around 20.9% versus 29.7%. The street was anticipating at least around 25% this quarter. Now, in terms of the profit, that also was impacted because of the weak operational performance. Revenue was up, however, by 6% The street was anticipating around a 7% growth. So that was largely in line with estimates. India was strong, so it was up around 25% year-on-year plus. Asia was strong, it was up around 30% plus. US was weak, so that was down 5% on a year-on-year basis. And the institutional Africa sales was down around 50% year-on-year. So that really brought down the overall performance. Now, in terms of a couple of key takeaways, the margins the company did say was impacted by raw material freight costs, price erosion in the US, preponements, confident on guidance. They have guided for around 26% margins, and they expect Asia to grow around 20% plus, India to grow in high teens as well. Brokerages such as Motilal have maintained their buy call, so target price 1560 there. They've cut their FY23, FY24 estimates, however, to factor in lack of launches in the US market and moderation in growth prospects in Africa. Incred maintains an ad with a target price of 1439.
Okay, thanks a lot, Ekta, for that. So that's on Ajanta Pharma. But let's just quickly get a handle on what's happening with Hero MotoCorp and why it's the biggest loser on the index right now. That's because of the earnings that Hero reported. Now, the revenue growth was fine. It was decent, about 7%. The problem really is in margins. Despite the raw material costs coming off, the company continues to see margins under pressure. In fact, this time margins were down 110 basis points year-on-year at 11.4%. And that has dragged down the overall profitability as well. Profits are down to 716 crores versus almost 800 crores same time last year. Now, volumes also continue to be under pressure. There's no major recovery in the rural markets for Hero MotoCorp particularly. Total Q2 volumes were down 0.7% year-on-year, and the management is a bit cautious. They do say that the global macro headwinds may keep the play field a bit uncertain, and navigating the same over the next few quarters will be quite important. So Hero MotoCorp reporting a weak set of numbers, especially on the operational front. Let's do one thing. Let's take a quick commercial break. On the other side, coming up, a special Indianomics where Lata, seeks reactions to the report that the RBI discussed with the MPC yesterday, explaining why inflation has remained above 6%, as also the impact of a more hawkish Jerome Powell on India's monetary policy. Stay tuned.